Now I want to talk more about interest rates. Traders are starting to see a higher chance that the Fed will raise its benchmark interest rate, a 34% chance to be exact. But Brian Edmunds, managing director and head of interest rates at Cantor Fitzgerald, says it's probably a long way off if they actually do that. Brian, thanks for coming on the show. Let me first ask you. We were talking a little bit during the break. It's unlikely, in your opinion, that the Fed raises rates not only this year but also in 2010.
Yes, Matt, thanks for having me on today. I think the markets have gotten ahead of the Fed. As of Friday's employment report, we saw the market start to price in a Fed tightening as early as November of 2009. And that sounds extremely quickly to us for the Fed to actually raise rates. I believe the Fed's committed to keeping interest rates low for a long period of time, and it will take some time for the economy to really show signs of strength, continued and extended strength, before the Fed will go into a tightening mode.
At the same time, and I mean, it's interesting, this chart. This has nothing to do with the actual. I'm not a technical analyst here, but there is a V in the chart. Investors are pricing in a V-shaped. It seems like they're pricing in a V-shaped recovery. Again, not because the chart looks like a V, but I just thought that was interesting. Is that one of the reasons you think that that bond traders are betting there could be a hike in interest rates?
Sure. I think there's a combination of events recently that have pushed us that way. The economic news has printed stronger than expected. While it's stronger than expected, it's not strong economic news. And I think that has forced traders from pricing in very, very weak economic news to restraining themselves and taking off some positions. The front end of the curve was especially hit hard on Friday, with two-note interest rates going from approximately 95 cents to about a 140 basis today.
What do you think about the yield curve and the steepening that we've seen recently? I mean, a lot of people are saying, hey, this is good for the banks and for financial companies. Is it healthy, though, for the economy?
To a certain extent, it sure is. I think the banks can lend long and borrow money at very low rates in the short term. So that helps the economy. As interest rates start to ratchet higher, it will start to dampen the effect that the low mortgage rates have had on the economy. And I think there's also a sense that there's a bet going on against the U.S. in certain ways with the fiscal policies that are currently in place, that there's some limit to the amount of borrowing that the U.S. can do and consistently remain at a low interest rate environment.
All right, if you have a moment, I'd love it. You could stick around. We're going to take a quick break. We'll come back, talk a little bit more with Brian Edmunds. We are back with Brian Edmunds, managing director and head of interest rates at Cantor Fitzgerald. And I want to just touch base quickly with you on the 2-year, because for months now I've been seeing it stuck around 0.9%, and all of a sudden it shot up. What happened last week on Friday?
Over the past few weeks, we've seen a lot of pressure in rates at the long end of the yield curve. We've seen higher interest rates in 5-year notes, 7-year notes, 10-year notes, and a 30-year bond. And the 2-year note has been stuck in a very, very tight range. And I think Friday's trade was more about positions. I think there have been a lot of investors who were willing to be in 2-year note interest rates and avoiding the longer interest rates in the U.S. And on Friday, with the, I guess, less weakness in the employment report, still being down 300,000 jobs lost, we finally saw capitulation in those front-end trading positions. So just because we were stuck in that range between 1% and 85 cents in 2-year notes for the last 6 months, it seems we've broken into a new range, which is going to be probably outside of a 1.25 yield on the 2-year notes.
What's the deal on the 10-year? I mean, investors have pushed the yield up or not been buying them and pushing the yield up for so long now, 3.84%. Is this a challenge by people for the Fed to actually come in and buy 10-year treasuries and related, mortgage instruments that everyone's been expecting them to buy in the secondary market?
Well, I think it's a challenge a bit to some of the policies that have gone on in the U.S. I think last week you heard Chairman Bernanke for the first time first time in a while, talk about fiscal responsibility in the markets and how important it is, I think, at some point for the U.S. to send a signal to the world that we just can't continue to spend without having responsibility because the dollar has been under pressure, the long end of the yield curve has been under pressure. Interest rates historically are still pretty low, but I think those risks to higher interest rates have escalated as the yield curve has steepened and long interest rates have gone higher.
All right, Brian, thanks very much for joining us. Brian Edmunds there, Cantor Fitzgerald.